A warm welcome to the Risk Reversal podcast. Always delightful to be joined by the great Peter Boockvar. Peter, as you know, does extraordinary work. He's with us on a weekly basis. We're fortunate to have him. Peter, how are you?
Guy, great to see you again.
It is great to see you, and we're doing this talking on Tuesday afternoon, so ahead of some of the rhetoric or some of the emotion or some of the news we're going to get out of this Fed meeting. But clearly the market's in a buy everything mode and, throw caution to the wind. We'll see how long that lasts into this Fed meeting and the subsequent commentary we're going to hear from Jerome Powell. So set us up a little bit here.
All right, a couple of dynamics. On the market side, I think you're right. Market participants for many, many years, as we know, have been trained to buy stocks with upon rate cuts. And that's certainly what they've been doing. And it's not just stocks. They've been buying corporate bonds. Treasuries obviously have been rallying. The metals have been rallying. Essentially everything, or most everything, has been rallying in anticipation of these cuts because that's what people do. That is what has worked. I think one thing that's forgotten, though, is the question of, well, why is the Fed cutting interest rates? I think that question is not really being analyzed enough, because if it is now happening more so because of the weakening labor market and a rise in the unemployment rate, that's where I think people should sort of do a gut check and say, okay, we've pushed asset prices to such a level. Is it warranted from here? Because the Fed is cutting in response to a softening economy. I think the dynamic within the Fed is also very fascinating. We obviously have Stephen Myron, who is going to be voting for the first time, as he just got confirmed. And I think the question with him is, does he sort of ease his way in by just agreeing with the committee to cut 25 basis points? Or does he make his pound his fist and the table and say, we deserve 50? Because that's what the administration would be happy with him doing. On the flip side, the administration's attempt to remove Lisa Cook from this vote failed, and she will be voting. Is she going to say, hey, I'm going to push back against the administration and I'm going to vote for no cut?
Mm-hmm.
That's an interesting dynamic. And also with Waller and Bowman, who dissented at the prior meeting in wanting a 25 basis point cut that was not given. Does Chris Waller, who's one of the leading candidates for the next Fed chair job, does he say, hey, I really, really want this job. I'm going to now vote for 50. So political dynamics, position jockeying dynamics, the right way to respond to what's going on. I give the Fed, okay, cut a couple of times. But one of the other really important things that I think investors should be focusing on is not just what the absolute statement says or the cut or what Powell says in his press conference, is what the dot plot says specifically with what their long-term expectations are for the real rates. Because I think that's being misunderstood by people, because I hear people say, oh, well, the neutral rate's 3%, and therefore the Fed should just cut right to 3%. With somebody saying maybe the Fed should even cut 75 basis points at the September meeting. Well, I said, well, the 3% neutral rate, first of all, is a nominal rate, and it is only the nominal neutral rate if, emphasizing if, inflation's at 2%.
That's right.
And their long-term neutral rate is a 1% real rate. So here we have inflation at around 3%. The effective Fed funds rate's at 4.33. We'll get slightly above that with the cut. But if 1%, if the Fed holds at that 1% real rate as their long-term target, one or two cuts gets you there.
Right.
Therefore, in order to get subsequent cuts from there, you're going to need a further deceleration in the inflation rate and or major deterioration in the labor market where the Fed says, you know what, 1% real rate's too high. We need to go to 50 or we need to go to 0.
All right, so let's play that out a little bit, because it's one of these special meetings where, they get the dot plots, you get forecasts, all these different things come into play. You also have clearly an open auditioning from some of these members without question. And I do think Mr. Myron's going to be on the 50 basis point cut vote, because I think that's going to be politically expedient for him. We'll see if I'm wrong, but, my sense is that's what takes place. With all that said, you just nailed it. They need inflation to cooperate in order to get these numbers to line up. And it's been doing anything but cooperating. It's been trending in the wrong direction, in my opinion. At least that's what the data suggests to me. And on the flip side of the coin, the labor market is deteriorating. Again, I don't want to make a big deal out of 4.3% unemployment, but you've said it before. Elizabeth Thomas talks about this. You start to hit sort of escape velocity on the employment picture, and it's really one of those things you think you have control of until you don't. And I don't know how they sort of extricate themselves from what to me seems inevitable at this point.
I agree, and with the unemployment rate, I encourage people to, in addition to that U3 number, which gets to that 4.3, I encourage people also to look at the U6 number, which is sort of a all-encompassing unemployment rate, because that number at 8.1% is the highest level I think since 2021, and that includes people that are working part-time that can't find full-time work. Because right now, if we're seeing still a muted pace of firings, but a reduced pace of hirings, where not only is it tough to find a new job, but as I said, people working part time are having a more difficult time working full time. And also, that a number includes what's called discouraged workers, where you were once technically unemployed because you were looking for a job, but then you said, you know what, I'm taking myself out of the labor force. I'm no longer looking, but would take a job if offered. That's also included in that number too. So I think that is something that the Fed is really focusing on. But yeah, to your point, and what I'm trying to make too is that while the market seems to be pricing in the ability of the Fed to be having license to combat any economic downturn, and that 3% persistent inflation is somewhat of a limitation in terms of their flexibility. And I don't think the market has realized that just yet.
Why has the bond market behaved as positively as it has? It surprises me. Now, I think part of that is the weaker data. So I think rates are coming down on the back of that, which is not necessarily a good thing. But, the inflation numbers have been at worst warm, at best, somewhat hot. Yet the bond market seems to be sort of favoring, I guess, slower growth. I mean, it's surprising to me. Is it surprising to you?
Well, it is responding more to slowing growth, because if you look at the inflation break evens, 2 year, 5 year, 10 year, they have really not fallen that much, which implies that the drop in nominal yields is more in response to those concerns about the economy rather than a bet that inflation is about to decelerate. So, in a way, it is a stagflationary type response to the data. Now, the question is are we going to see a repeat of what we saw, not necessarily after the September 2024 beginning of the 100 basis point cuts when long rates went up, but prior to that, when the market started to price in the beginning of a rate cutting cycle, the long rate went from 5% at its peak in the summer of or the fall of 2023 into that 3.6% level on that day in September 2024. So are we seeing that repeat where long rates are falling right into that Fed meeting? And once they start cutting, long rates are going to head right back up again. I think that is most likely. So that is going to be an interesting thing, because, and also keep in mind, so the Fed is going to cut, we know that will take total cuts down about 125 basis points. Well, on that day, September of last year, the 10-year yield was 360.
Mm-hmm.
Even with this drop in the 10-year yield that is notable off the highs this year, it's still above 4%. It's still 40 basis points above where it was when the Fed started cutting a year ago.
Which, again, is either encouraging or, to your point, concerning. I guess it really depends on how you view this entire thing. I view it as somewhat concerning. I think you're right to point out the fact that, this could be a replay of what we saw this time last year. I saw Secretary Besson on Squawk Box, and he talked about that. Becky Quick said to him, you obviously remember in September of last year, the Fed cut interest rates and the 10-year yields went higher on the back of it, and the Fed controls the front of the curve, not the back end. He pushed back a little, saying the scenario was different last year. We're in a much better position this year. We'll see how it plays out. But you look across the landscape and you see what's going on with global bond yields, although the moves higher have seemingly slowed down for now. I mean, there's still levels of concern out there. And this debt problem that we have is not going away anytime soon. And, their ability to fund the government with bills, at some point they're going to have to go longer duration stuff, which to me is all bearish for the bond market.
I agree, and adding to the great points that you just made, there are a few other very important central bank meetings this week. The Bank of England meets on Thursday, and they currently have their base rate of 4%. They're not expected to move. So maybe the Bank of England has made the adjustments that they've had to make because inflation is remaining sticky there. And we certainly know that they have a debt problem that the long end of the curve there is quite worried about, with the 30-year gilt yield near the highest level, just off the highest level since 1998. Also, the Bank of Japan meets this week. They are not expected to move, but a couple of stories over the past couple of weeks are sort of laying the groundwork for not just an October hike, but also potentially a December hike. So while other central banks like the Fed is cutting, some are sitting tight, the BOJ is raising interest rates still. They have a major inflation problem on their hands. I say major, especially relative to the last 30 years. It cost the prime minister his job, the pushback against higher inflation. So I cannot say that this long end duration sell off that we've seen over the past couple of years is over. I think that the rally in US Treasuries on the long end is just a respite before another leg higher in yields.
Listen, I'm with you on that, and it'll segue to the next thing I think we should be talking about, and that's this continued weakness in the U.S. dollar. Now, the weakness abated for a period of time, but as we're sitting here right now, you have the dollar euro approaching 119, probably in terms of the euro, the strongest level it's been in 3 years, or the weakest level the dollar's been in 3 years. Dollar yen is either side of sort of 146 and a half. I don't want to make a big deal out of that yet, but we've seen what's happened before as the yen strengthens against the dollar. I don't know what to listen. I shouldn't say I don't know. I sort of know what to make of it. I think, quite frankly, there is a policy out there that wants the dollar to weaken because, again, when you're sitting on a $38 trillion debt, you're not going to grow your way out of it. You're going to devalue your currency your way out of it, which works until it doesn't. So why doesn't the equity market, historically, a weaker dollar has been good for equities. I get it. When does the equity market start looking at it through a different lens?
I think when it starts to show up in two ways. There's this very simplistic belief on the part of some that, well, S&P revenues, 40% of which are derived overseas, they benefit from a weaker dollar. Therefore, a weaker dollar is just fine. Well, maybe to an extent, because 40% of US imports are raw and intermediate term goods that only get more expensive when the dollar weakens. Also, the belief that we being markets and certainly the administration, was yes, we can put tariffs on, and that is going to be offset by a stronger dollar because technically the tariffing country sees a stronger currency. Well, we've obviously seen the exact opposite. So having a weaker dollar, in addition to the tariffs, makes those tariffs even more expensive and pushes the burden even further onto US importers and US consumers. And lastly, broadly speaking, if the cost of imports go up, those price increases eventually get spread out through the broader economy. So a weaker dollar, yes, on the one hand, also could be some excess liquidity, weaker dollar, and so on. But there are constraints too with a weaker dollar that we have to be careful with, because the worst thing that we want to see is if the dollar takes another leg down, worries about inflation goes up, and interest rates actually rise in
Right.
response. And you get that real negative, a weaker currency and higher interest rates.
Which, by the way, we saw glimpses of a couple different times that actually Janet Yellen addressed 6, 7 months ago. I lose track of time, but on one of those Sunday shows, she actually talked about some of the concerns she had with rising interest rates against a weaker dollar, something historically we really don't see in this country. And I think it's worth watching, which, all roads lead then to gold, which has clearly been trying to tell a story. And I think I read recently that central banks now have more gold reserves than they have of U.S. Treasuries, which, again, I don't know if you find that interesting or not, but I certainly do, because I think it speaks to something that I've said. I think central banks are hedging their own ineptitude.
Yes, and also there's no doubt that this buying started to ramp up. And to define the buying, 3 years leading to this year, central banks bought more than 1,000 tons a year, which has been never before seen. The pace this year is a bit slower, but that's partly due to the higher prices.
Hmm.
I think the day after the EU and the EUS froze half of Russia's central bank reserves, it woke up a lot of central bank officers and certainly top people in China and other places saying that we need to own more gold and own less U.S. assets. 25 years ago, if you look at the central bank reserve pie, about 75% of that was U.S. dollars. That's now down to 58%.
Hmm.
Gold is now in second place in terms of value, just surpassing recently the euro. Gold is also becoming a very important sort of settling asset. So if China is buying oil from Saudi Arabia, whereas previously they were doing it in dollars because we had the petrodollar and all transactions were taking place in the US dollar, well, they're buying it in renminbi. Now the Saudis are then taking that renminbi and probably buying stuff from China. But there is also some excess currency that takes place that is now settling in gold. Whereas before, China would buy oil from Saudi in dollars. Saudi would take those dollars, they would buy US treasuries. Or China would be exporting a lot of stuff to the US. They would take those dollars, they recycle back into US treasuries. Well, now the US is buying less stuff from China. China's selling more stuff to Southeast Asia and Europe. And gold is now becoming sort of a settlement currency in a way where any sort of overflow is not being kept in dollars or not even beginning to be denominated in dollars. And in order for some of these countries to own less of their currency that they're trading with, maybe they're settling in gold. So it's become a central bank reserve asset. It's become a settlement asset. And now you have ETF holdings that are beginning to increase. So it's becoming now retail is saying, wow, price of gold's going up. I need to get involved here. So it's a combination of these things that is now finally taking up silver. Platinum's had a good move. So a move into these hard assets are becoming more and more attractive.
Yeah, and you can't draw necessarily a straight line, but in large part, these tariff concerns or these tariff announcements have sort of paved the road for everything you're just talking about right now. And that's not political. I just think people sort of reading the tea leaves and trying to figure out how to sort of get around these different things. So there are knock-on effects for these tariffs, whether people want to acknowledge them or not. And before we get to the next thing, which is
One good example to that point, Guy. I read in the paper yesterday that Denmark, instead of buying Patriot missiles, are now buying a similar technology from a European military company.
mhm.
Now, granted, we pissed them off with wanting to take over Greenland, but that is dollars. That's not going to RTX, which I think who makes the Patriot missiles. So you don't have Denmark procuring dollars to pay for these Patriot missiles. They're just doing it. They're just switching over to euros from their own currency. So this stuff is going on. And to your
Mhm.
point, we've the rest of the world, and I'm not saying this out of my opinion, talk to people outside the US and they feel stiff armed by this whole tariff policy. And many countries are doing what they can to start trading less with us and more so with themselves or with other non US countries, whether that is from a supplier standpoint or an end consumer standpoint. Now, that's an evolutionary thing that takes place and that will evolve over time. But that's something that's taking place too and affects transactions with the dollar, reserve bases, gold, and so on.
Listen, that's how it starts, right? You implement protectionist policies, and there are implications. I mean, that's just we've seen it historically, so it's not like this is without precedent, and we'll see how it plays out. The only sort of judge and jury that people look at is the U.S. equity market, again through the lens of the S&P 500, which, as we're sitting here, made an all-time high today. So it's very hard to try to hammer home that point when the equity market seems impervious. But it doesn't mean it's not going on below the surface. Or right now, forget about below the surface, right in front of everybody's eyes.
Right. So we know, and I'm saying stating the obvious, that the S&P 500 is where it is because the AI tech trade has gotten a second wind. and after the hit it took when the DeepSeek news came out. And when you have the top five stocks that are almost 30% of the index, and you add another five and you're up to 40, it doesn't take too many stocks to go up that can
Hmm.
drag this entire index up. Now, you've had small mid cap stocks that have recently rallied, but that's been more of a let's buy them because the Fed's going to cut rates trade, but also some deserved catch up. They've been left for dead, and it's good to see the market broaden out to that. But the importance of this AI tech trade and the sustainability of it will single-handedly determine where the S&P 500 goes over the next 1 to 2 to 3 years.
Let's get into your note about home builders, because there's this belief that everything in terms of the home builder sector is predicated on rates going lower. And there is some truth to that. Obviously, lower rates are going to be a bit of a tailwind for the home builders. And you can overlay charts and stuff and see how these things have traded historically. But there are other factors at work here. And I think that if you really look at the data, which you do, I mean, there's some concerning things around the home builder trade that, for whatever reason, people are not paying attention to. One of them, by the way, happens to be inventory, which I think is at close to 11 and a half months or 12 months of new home inventory out there. I think the historical norm somewhere between 6.5 and 7 months. So you have all these factors seemingly working against the home builders. Yet people are laser focused on rates going lower, thinking that's going to be sort of some salve to help these stocks. What are your thoughts?
Yeah, it is a growing interest dynamic, and to sort of split up the new home market with the existing home market. The new home market, these builders, in order to push product, have been buying down mortgages. They've been cutting price. They've been adding other incentives like extra stuff in the kitchen, for example, in order to drive product. That has actually allowed them to sort of take some market share from the existing home market, which is still stuck with this lock-in effect with so many people having mortgages that are under 5%, that even with this decline, this recent decline in mortgage rates to south of 6.5, may not be enough to sort of get more existing home supply out on the market. Then you've had also the hotter markets like Phoenix and Miami and Tampa, Austin, Texas, where there was just too much building. And that's where you're seeing the possibility and the reality of a bunch of home price declines. So also, if there's one lesson that we learned over the last 20 years is that when the Federal Reserve, via zero interest rates, 1% interest rates on the Greenspan, buying all these mortgage-backed securities, if all you do is step on the gas and push demand, if you don't get a coincident increase in supply, all you do is, while you get lower mortgage rates, you get higher home prices that offset the benefit of lower mortgage rates. So it's really crucial that if long rates are going to stay lower, if even though mortgage rates are still elevated compared to where they were just recent, a couple of years ago, if you start pushing on the demand pedal and you don't get an increase in supply here, you're not really going to get any benefit. The hope is that maybe lower mortgage rates can actually get people off the fence on the existing home market and say, okay, even though I got a 3% or 4% mortgage, okay, I'll move. I'll take the 5.5. It's down from 7.
Mhm.
I still have to pay extra, but I'll do it. You need more supply, particularly for that first-time home buyer that is suffocated from a doubling in mortgage rates and a 50% rise in home prices. And I want to emphasize too here that the National Association of Home Builders, just to quantify the importance of the housing market in the U.S. economy, if you look at the entire scope of housing, everyone from the builder to the producer of lumber to the real estate broker to the title insurance company, that's 15 to 18% of US GDP that has essentially been frozen over the last 3 years. So when we talk about the economy, GDP is here, it's very nuanced. AI data center construction's in a boom, housing's in a recession. So hopefully maybe we can get some shaking of the tree and some loosening up in the housing market here. But a lot will depend on, if we're going to push demand, we need to see a coincident increase in supply as well, so it can give buyers some relief.
Yeah, look, I mean, the unfortunate reality is the loosening in the home building sector might take place on the back of the unemployment rate going higher, because then that gives people, unfortunately, no choice but to make these decisions. And I think that's a potential reality of this whole thing. Be careful what you wish for, because the home builder market, or the building market, the home market might loosen up on the back of people losing their jobs.
Right. That might be the sort of unfortunate increase in supply, where someone can't afford their mortgage payments, and somebody forecloses on that home.
Not.
We're
Yeah.
certainly beginning to see that in on the auto side, with auto delinquencies
Hmm.
rising and credit card delinquencies rising. So that is something to watch for sure.
No, yeah, absolutely not. I'm not looking to be dire here, but you just, again, trying to read the tea leaves, and all those things are sort of, they're sort of staring at you. And I think there's this hope that we're going to be able to sort of avoid collisions with a lot of these things. But inevitably, if you're trying to avoid a number of different things, the unfortunate reality is at some point you're just going to hit one, almost by definition. But right now, it's seemingly they've been able to sort of, the Federal Reserve, and to a certain extent the administration, has been able to avoid all these things. We'll just see how long it lasts, Peter.
Well, rate cuts and the prospect of them, as we've seen over the last 20 years, have become sort of a medication for the markets. It sort of has been a painkiller. It doesn't cure the disease or the pain, but it dulls it, and it makes you feel like it's not there. And we're seeing just a replay of it. But I just want to just encourage people to look at history and understand that rate cuts, while again historically are good for markets, they're not always good for markets, because if it's happening because the economy is softening, then that's where the market starts to turn eventually and say, I need to focus more on what's going on with the economy and earnings. That rate cuts are not going to cure, because getting to the point about this AI data center construction, when we reach a point where that spending starts to slow, and we will, who knows when it'll be, no amount of rate cuts are going to help that. Once you build overcapacity, you need to digest that
Right.
overcapacity, and rate cuts are not going to do that. We saw that with fiber optics, and we saw that with the housing market. Only time cures any overbuilding. So I just think that people need to also think about that, and also understand that the days of going back to zero rates are over. I still believe that that we're in a Fed rate tweaking cycle, not a wholesale cutting cycle, because the unemployment rate is ticking higher here. Because I think, again, the inflation rate is going to be tying their hands.
Right. And what you're talking about in terms of AI is the sanctity of CapEx. And again, we didn't even get into the lack of impact that tariffs have had on the inflation rate, just in terms of some of the commentary that we've heard. Now, people will say that once it hits, it's going to be a one-off, but these inflation numbers going higher, or at least marginally higher, don't even include the impact of tariffs, which inevitably will be felt as well. Just last thoughts on that.
Well, in the CPI number that we saw last week, in a variety of goods, prices are up across a bunch of them. And if you look at the numbers over the past 4 months, so May through August, sort of capturing those tariff increases, a bunch of good prices are up, and on a year-over-year basis, goods prices have curled up. But to your point, yes, the back half of this year was when further tariff increases are going to show themselves, because a lot of the inventory that's been sold off shelves over the last couple of months have been products that were procured before the tariffs had its impact. Now the stuff on the shelves are the price of the product plus the tariffs, and then retailers and other parts of the supply chain are going to try to push that forward onto the rest of us in the back half of this year and early next year.
Peter, I know I love talking to you. More importantly, I know the audience loves listening to you. Where can they find your amazing work?
So my daily commentary is on Substack. It's peterboockvar.substack.com, and it's called the Book Report. And on the wealth management side, if anybody's interested, they can go to our website at onepointbfg.com.
You're the man, Peter. Always enjoy speaking to you. We'll get you again next week. Enjoy the rest of this week. It's going to be, I think there's a lot to be looking out for and listening to.
Thank you, Guy. See you soon.